The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you for joining us. I'm Mike Sadek. I'm the Managing Director of Retail Trading at Lightspeed. And today we're pleased to bring you this live webinar on effectively using ETFs to leverage your point of view. Joining me today, I have Michael Eschmann, the Senior Vice President at Direxion Shares, and Paul Weisbruch, Vice President at Street One Financial. Mike and Paul will focus on two sectors which are very hot right now, those being metals and energy, and share with us some of their strategies on using leverage ETFs as a unique way to trade these sectors. We're going to do a short Q&A session after the presentation, so please enter any questions that you might have into the chat box on your webinar console, and we're going to attempt to answer as many as time allows. As always, this webinar will be recorded and will be posted within a few days on lightspeed.com for future viewing. Please remember that this webinar is being provided to you for educational purposes only. No information presented constitutes a recommendation by Lightspeed Trading, Direxion Shares, or its affiliates to buy, sell, hold any security. So with that disclaimer out of the way, I'll turn the presentation over to Mike and Paul so we can get started.
Great. Good afternoon, everybody. Thanks a lot. This is Mike Eschmann. Very happy to be here with you guys today. I just wanted to thank Mike and Lightspeed for inviting us to speak a bit about some of the types of trades and opportunities that we've been seeing in the market recently. But before we jump into all that, I'm very pleased to have Paul Weisbruch on the line with us. Paul is a good friend of mine, and in my opinion, he's one of the best ETF traders on the street. So we're lucky to have him here. Paul and Street One specialize in sourcing liquidity and providing best execution in the ETF space, options and equities for the RIA and hedge fund community. So as I discuss some of the themes that we've been seeing, Paul's going to talk a little bit about some of the best practices for trading the ETFs. So Paul, thanks for joining us.
Thanks, Mike.
Yeah, no problem. The first webinar we had with Lightspeed sort of focused on the basics of leveraged ETFs, leveraged ETFs 101. So I'm not going to spend too much time on that, but I do want to just run through some quick a quick overview of some of the finer points, some of the things that you need to understand with leveraged products for those who missed the first webinar. The leveraged ETFs are basically their trading tools. They have daily investment objectives, which means they're going to seek to offer you 2 or 3 times the return or the inverse, -2 or -3 times the inverse of negative 2x or negative 3x the return of an index only on a daily basis. That's important to understand. These products reset every night. So today they're going to look to give you 2 and 3 times what the index does. Tomorrow they're going to look to give you 2 and 3 times whatever the index does that day, the day after, and the day after. So if you're investing in these products and holding them over longer periods of time, it's important to realize you're not going to get 2x or 3x the return of that index over that time period. You're going to get a product of each day's leverage return. For instance, if you invest $100 into a 3 times levered bull fund, and the index that fund tracks is up 2% today, you're going to be up 6%, right? 3 times leveraged on a 2% return. You're going to be up 6% today. If you hold that position overnight, you're basically going to be reinvesting that $106 of that $6 gain at 3 times exposure tomorrow. So, you know, if you keep doing that over the course of several days, you're basically re-exposing any profits or gains from those days' returns. So it's important to sort of understand how that affects you. It's called daily compounding, and it can be positive or negative. It can work both for you and against you. In trending markets, the daily compounding will tend to work in your favor. As I said in the previous example, if you invest $100, the index is up 2%, you make $6 on that. If you hold the position overnight and the market is up tomorrow, that's great. You've reinvested your gains and the market has gone in your favor, and you're going to do better than 2 times or 3 times what that index does over that 2-day period because you're reinvesting your gain. That's positive compounding. That's compounding working in your favor. The trend is your friend. when it comes to the leveraged ETF. Negative compounding occurs on sort of sideways markets or very volatile or choppy markets. You don't want to be in these things over longer periods of time in those types of environments, sideways or choppy markets, because you'll tend to underperform 2 or 3 times what the index does. Very important feature of the leveraged ETFs, and very important to understand and to understand how they work in different types of trading environments. Typically we see our products or leveraged ETFs most often used as short-term directional plays. For instance, our tech bull and our tech bear had big spikes in volume yesterday as traders were looking to speculate on the Apple earnings that came out after the close yesterday. So short-term directional plays, very often see them used in that fashion. Portable alpha and efficient deployment of capital, that's basically just saying, you're using the leverage products to get a certain type of, a certain amount of exposure by only putting up 1/3 of the capital. Right? If you're looking for $100,000 of exposure to a particular sector, by using a 3 times leverage product, you only have to put up $33,000 to get that full $100,000 exposure. You then have 2/3 of the capital remaining to invest in non-correlating assets, which can help diversify your portfolio and help you manage risk a little bit better. We see them used in that capacity. And then, of course, the hedging strategies. We very often see them used as hedging tools. Particularly at year-end, traders who may want to protect profits but don't want to incur any taxable liabilities by selling out of their position will often use a leverage product to hedge that position or that portfolio. So those are some of the ways that we see them most often used. Gold, I think we're probably all pretty familiar with the huge run-up in gold over the past few years. I think G. Gordon Liddy has kept us well apprised of that. Gold has sort of become the safe haven for just about everything. Risk of inflation, a sovereign debt contagion, even the debt ceiling here in the U.S. Gold has really sort of become the safe haven of choice for a lot of investors out there. Big hedge fund managers like John Paulson, George Soros, a lot of the gold bugs out there have established huge positions in gold over the past few years. In fact, GLD, which is the preeminent gold ETF out there, has physical gold backing it. More so, it has more physical gold backing it than the central banks of China, Switzerland, Russia, Japan, and India. So just a tremendous amount of gold. It's become pretty mainstream and a core holding in a lot of portfolios out there. But what we find is that traders will often prefer to trade the gold miners. Gold miners are sort of a way to a higher beta way to play the gold trade. Typically, the gold miners are a bit more volatile than gold itself. They tend to benefit from an increase in the value of gold as it will often lead to an increase in profitability with the gold miners. But it offers a bit more volatility, which, as we know, traders tend to like. However, it's not always the case. Back in the end of May or early June, Credit Suisse put out a piece that said, hey, we think gold miners are undervalued right now in relation to the huge run-up in gold and the spot price of gold. And right about the same time, we at Direxion sort of noticed a pretty big dislocation between the historical spread of gold and gold miners, sort of validating what Credit Suisse found as far as their undervaluation. And we started to make a lot of noise about that, sort of pointing this out as an opportunistic or possibly an opportunistic trade, as the spread was historically wide to where it normally is. And here you can see right around June 17th there is when we sort of started making a lot of noise about this, and subsequently Barron's put out a big article on this very topic. We started to see color popping up around the street highlighting this trade that gold miners might be undervalued here. And believe it or not, from June 17th here, which was sort of the bottom, Up until just yesterday, our 2 times gold miners ETF Nugget is up over 30%, as traders, were utilizing it to sort of collapse that spread there. We saw huge increases in both volume and assets in Nugget, and I know there was big run-ups in volumes in a lot of the other gold miner ETFs and options as traders were looking to exploit this dislocation. And this here sort of is this just shows the run-up or the increase in assets as Nugget was being used to sort of take advantage of this dislocation. A lot of these guys still feel like that it's an opportunity. That spread is going to continue to collapse. But we at Direxion like to offer both sides of the equation here. There is a case to be made for the bears out there. Analyst at UBS, Julian Garin, points out that maybe gold miners aren't undervalued here. He points to the tighter credit in the emerging markets, which is where a lot of these gold miners operate, as being one of the factors, for the downward factors on gold miners going forward. Also, the unwind of a very popular trade over the past few years, which was to short the dollar and go long commodities in the emerging markets. His point is, as that trade starts to unwind, it's going to put a lot of downward pressure on both gold and gold miners. But I think it's a pretty good example of sort of identifying an opportunity in the market and using one of the leverage products to really benefit from that opportunity. And as I said, Nugget is up over 30%, in less than a month as traders, look to exploit this dislocation here. And with that, I'd like to pull Paul into it to talk a little bit about some best practices for trading the ETFs in an environment like this. Paul?
Yeah, thanks, Mike. Here you'll see just a screenshot, basically level 3 depth of book, if you will, that you can see on any trading system that offers this type of quoting, and it has the various bid-ask quotes and levels of liquidity in NUGT, one of the funds we're speaking about here. Now, these are rather new funds, so you won't see typically millions of shares trading hands on a daily basis, nor will you see a ton of size on the inside bid or ask or in the book itself on a regular basis. I expect as these funds mature and they're out there and the awareness grows, you'll just see more volume and as well as tighter spreads and more activity. But make no mistake about it, just because there may not be a ton of volume or the spread might be wider than you'd like, you can certainly get trades done efficiently and seamlessly and not affect the price. And that has everything to do with the fact that both Nugget and DUST, DUST, the other side of the trade, are tied to the same index that Mike was speaking about. And they're based on very, very liquid components. The index itself is composed of a number of mining stocks, and those stocks trade millions of shares on their own right on a daily basis. So that said, you can kind of test this out for yourself by looking at NUGT or DUST on any given point of any day, and with or without the volume, the fund is still recalibrating and pricing itself, because that's the role of all of the arbitrageurs and the market makers and really everyone who's pricing this ETF, is to bracket the price around what the index is doing, obviously taking the leverage into concern. So that said, you can kind of test this out on your own, and you'll see in a live scenario, the price of the fund is always moving based on the NAV or the IV of the fund itself. And when it comes down to effectively placing trades, you want to have some sense of what the NAV or IV is. And generally, you can figure that out on, there's free sources that have it. Perhaps, I'm not sure, Lightspeed probably has a way to do it as well, where you can find the IV of the fund. And generally, that value will fall in between the bid and the ask. It's important to have that value in mind when placing orders, especially if you're using limit orders or using a trading desk. And I think the main thing that we try to express to people is to never use market orders. Even on smaller lots, it doesn't make sense to use market orders because you're unnecessarily going to cross a spread. Now, in this case with NUGT, you'll see the spread's only 3 cents. However, depending on the time of day, it could be wider. So, there's no reason to cross a 5-cent spread, a 10-cent wide spread, if you could get filled, say, mid-market, or get filled on the bid if you're a buyer, or get filled on the offer if you're a seller. So with a little bit of patience and with the right tools, you can get better fills and really recapture pennies, if not more than that, on your executions, whether they're 500 shares or 5,000 shares at a time.
Great. Thank you, Paul.
And Paul, I'll just jump in and add to that. In addition to benefiting from better pricing by doing the limit orders, Lightspeed clients have the ability to get the ECN rebates passed back to them. So not only, that's a huge reduction in their commissions as well, because they can get the rebate from the venue by placing limit orders.
That's a great point to make. Yeah, that's probably the best way to execute, as opposed to crossing that bid-ask spread unnecessarily, especially if you have some frame of mind of what the IV is. And if possible, I would also recommend to avoid showing your size when possible. I.e., if you have 50,000 shares of NUGT to buy, if you can use some kind of either parse the order out in pieces, or if you have the ability to use reserve quantity, which I imagine if you're going to the ECNs, you definitely do. And you can sort of mask what you're doing to the marketplace, and also that will lead to better results than kind of showing your hand, i.e. you're a buyer or you're a seller, because then people tend to trade around that information.
Exactly, and both reserve and hidden order types are available.
All right, great. One of the themes that we think is going to be big in the second half of the year and beyond is that of natural gas. We think it's going to become a very tradable sector, as there are a lot of storylines out there that support both the bull and the bears. Now, obviously, the future of natural gas is attractive for a lot of reasons. It's a cleaner alternative than fossil fuels with similar efficiency. It would help us become less dependent on foreign oil. And like the gold miners, the companies that derive their revenue from the exploration and production of natural gas, they offer another high beta way to play the natural gas trade. And there are a lot of sort of macro reasons that support both the bull and the bear side of things. On the bull side, there have been significant technological advancements over the past few years, particularly hydrofracking, which is a relatively new and cost-effective way for these companies to explore and produce and natural gases from shales much more effectively. Also, government subsidies. As the government looks to become greener or to sort of initiate their green campaign, they're offering subsidies to a lot of these companies for an increase in natural gas production. So that's lending some demand there. Potential widespread natural gas use in vehicles. We're seeing a lot more of that recently. And then also growth in the emerging markets in China. Now, the bears will argue that the global crisis and slowdown has depleted demand for natural gas, and the low price of natural gas has eaten into the margins of these companies and decreased the barrier of entry, which is bringing in new competition. Adding to the sort of headline risk in the area and making it a volatile and tradable sector are a lot of sort of new headlines coming out there. There was a New York Times article that was sort of much spoken about over the past few weeks. It identified this instance where the SEC has loosened the reporting rules for natural gas providers. Now, the companies argue that this is going to allow them to be more accurate in the reporting of their reserves, but the author of the article points out that it's frankly a negative, because they're going to start overbooking and sort of overvaluing what they're going to be able to produce from the reserves. On the bull side, there's an increase in the exporting of natural gas. Back to hydrofracking, the shales they're producing more from the shales with fewer rigs. You may have seen the governor of New York, Governor Cuomo, is looking into the possibility of digging or mining in the Marcellus Shale, which is a huge shale that runs from Virginia all the way up to New York. But then the bears argue that there's a lot of environmental risk with this. There's the risk of water contamination, which is going to lead to significant regulation, government regulation, which of course will eat into the profits of the natural gas providers. And there are a number of studies out there that show that some of the shales are not producing as much as they say they are. This is just a chart showing the huge run-up in production in natural gas over the past few years. So this is a sector that we really think is going to start to become interesting over the next several months. The products that we have that track this are Gas L and Gas X. Now, they're pretty thinly traded at this point, and this sort of goes back to Paul's point before, and I'm going to pull something up and let Paul point it out to you guys. But right now, they're pretty thinly traded at this point. But as a lot of these arguments start to play out over the coming months, we think we're going to see a bit more volume in these products. And getting it to what Paul was talking about, a lot of these products are more liquid than they appear based off of their average daily volume. So with that, Paul, I'm going to bring you back in.
Sure. Both Gas L and Gas X, as Mike said, are fairly new to the landscape, and therefore they average about 5,500 shares a day on average. But if you look recently, especially in Gas X, there's been considerable volume compared to the average in recent sessions. I see a 20,000 plus share day, a 30,000 share plus day, and no material effect to the index price, as one would expect. An ETF that is priced correctly and constructed correctly and is tied to a liquid index itself, you could trade millions of shares versus average volume of 5,000 shares and not materially impact the price, whether you're getting in and out. One thing to keep in mind is the spreads do tend to be wider than even NUGT and DUST, I should say, in these two. You could see a spread of 10 cents wide, 15 cents wide from bid to ask, but that doesn't mean you have to trade with that spread. Unlike stocks, the ETFs themselves obviously track that basket, and it's tied to natural gas equities. So you can definitely serve yourself well if you're patient, using limit orders, using advantage, as Mike had said, of the hidden feature or the reserve feature, and tap into liquidity that's not there, not present to the naked eye. In many cases, you might see, especially in these two ETFs, a wide spread, but if you're using hidden or discretionary bid or offer, you may get filled in the midpoint in between the bid and offer. And obviously, if it's a wide spread, you can recapture a significant amount of basis points there on each trade. So these are calibrated very well, and if you just look at them on any given day, they trade in lockstep with the index that you would expect them to, with the leverage taken into consideration.
Great, thank you, Paul. Yeah, so excuse me here. The leverage products can be excellent tools to express short-term views or opportunistic trades, but it's just important to monitor and act when necessary. These are definitely not buy and hold tools. You want to be aware of the type of environment you're in. As I mentioned earlier, volatile periods. You really just want to be in and out of these, trading them frequently. Less volatile periods, you can hold these a little bit longer term. Let that positive compounding work for you. But if you don't have the time or resources to do that, then they might not be the best products for you. You might be better suited with some of the one beta ETFs out there.
Mike, if I can throw out a quick idea, just something that
Sure.
we've seen from, I would say, the tactical and strategic community, those that are using technical analysis in ETFs. Products like these have gained a lot of traction, especially if you're using any kind of technical analysis system, because of the leverage. The leverage in a trending market where your research gives you very solid buy or sell signals makes these trades very effective. Obviously, you don't need a margin account to get the leverage. You can buy the leverage product. You don't need a futures account which obviously makes it very easy to use products like this to express very bullish or very bearish views on equities such as gold miners or natural gas equities. So that's been an increasing usage, I would say, of products like this, and it's successful when the trends meet the research, so to speak. So if there's any technicians out there, it makes a lot of sense to take a look at these products and as a way to express your views from a bullish or bearish standpoint, because in a trending market, you get that additional return from the leverage. And not only will you be right, you'll be very right. It's just a matter of rebalancing correctly, and again, as Mike had made the point a few times, not turning them into buy and hold instruments, really trading out of them with some frequency and using them to express quick views in the market. But that said, if you can look at Gas X specifically, or Gas L, kind of been a one-way market for the last few days, and if you look at the returns over those periods, it's more than 2 times, as you would expect, because it's been a straight trend one way or the other. So you can be on the right side of that trade, and your returns will be better than you had anticipated. So I think that's kind of an under-realized merit of products like this. Is when the trend is definitely your friend, and if it aligns with your technical analysis, these should be employed. It's just a matter of putting the trade on at the correct time and taking it off at the correct time.
Absolutely. Absolutely. So that concludes the presentation. Would like to open it up to questions if there are any questions out there for either myself or for Paul.
So guys, there was one question that came through from the audience, and again, we invite everyone to, if you have any additional questions, please go ahead and type them in now. And the question was regarding holding the inverse leverage ETFs, and it related to the dividends. If you're a holder of an inverse ETF, are you liable for any dividends that any underlying holdings might pay? Do you collect them, or is it neither? How do dividends work with these leverage ETFs?
Sure. Yeah. In the bull funds, the dividends, any of the stock dividends that are paid out on the long side, we have to distribute to the shareholder in quarterly income distributions. On the bear side, we're receivers of those dividends. The fund receives those dividends. So we typically have quarterly quarterly income distributions in several of our funds if we have positive net income. But on the bear side, they are the fund is a receiver. Does that answer the question?
Yes, thank you very much. And then we had some more questions about the order types that Lightspeed offers. So again, yes, we do. Obviously, we offer you limit and market orders. Specific to the limit orders, you are eligible to collect any rebates that are paid to us from the different exchanges, and those do vary by exchange. You can find a list of those fees and rebates on our website at lightspeed.com/pricing. We have smart order types, the reserve order types, hidden orders, iceberg orders. So basically any order type that you want to use to give yourself an advantage, we make available to all our clients through the Lightspeed Trader platform.
Yeah, to Mike's note, I would say everything he just described is basically the best way to trade these products. Using advantage of that hidden liquidity, using advantage of smart limit orders, not showing your hand. Obviously, if you can show something in reserve, you'll get really impressive fills in products and you could be trading a multiple of the average daily volume in these products. The two we just spoke about only trade 5,000 shares a day, but I think you'd be pleasantly surprised that you could execute 50,000 shares or more with relatively little impact, if not negative impact, just doing it properly as opposed to just crossing that spread and kind of haphazardly putting it out there.
Yep, exactly. I think we all agree. Okay, so Mike and Paul, you guys must have done a phenomenal job because I don't see any more questions coming in, so it was a great explanation. So with that, I would just like to thank you guys again. I think that's a tremendous amount of useful information and definitely very relevant with how hot these sectors have been recently. And I hope to have you guys back to do some future webinars and share more of your knowledge with our clients. So again, just like to thank you. And of course, I want to thank our audience for joining us today. As a reminder, again, we are taping this webinar, so you can come back at any time to our website and view the recording if you just want to follow up, or if you just want to go on there and view an existing list of our past webinars and get any of that information. So thank you, everyone, for joining us, and have a great afternoon.